Welcome to Channel 17, the Town of Colonie Government Channel.
Hello and welcome to The Money Factor. I'm Richard Naylor, your host. Our guest today is Rachel Zilonka, Business Development Executive from Sunmark Federal Credit Union. She was on our show before and we spoke of credit and budgeting, personal finance issues. She's come back because we didn't quite finish. We're going to go over credit scores and why the heck we have credit in the first place. So I'm going to welcome you back.
Thanks, Richard.
Rachel, you spend a lot of your time trying to counsel people.
Absolutely.
Do you want to just talk a little bit about that, just to give us a flavor of what you do?
Sure. My job in the credit union is I oversee our 350 employer groups who actually offer the credit union benefit to their employees. So essentially, I act as a financial mentor to those employees in those respective employer groups. And I really work with people individually, one-on-one, to help improve their financial situation.
Great. So you've met a lot of people who have problems, and so kind of have a first-hand feel for the problem.
Absolutely. I've been with the credit union just about 7 years now, and I've seen a large range of people's financial situations, being from stellar financial situation to probably mediocre, or we call it colorful. Financial situation.
No. Doesn't sound good.
Right.
Let's start with credit in general. Just talk a little bit about what credit is, because we have a credit card and we think of that as credit.
Sure.
And yet some of us use it for convenience, and then we don't have to carry cash and we pay it off at the end of the month, which in a way isn't really credit.
Right.
You haven't paid anything.
Right.
At least that you've seen. So what is credit about?
Well, from a financial institution's point of view, credit is your financial reputation for paying someone back. So I always bring up to someone, how much money would you lend your friend if you knew they had the reputation of never paying people back?
Or they hadn't paid you once.
Or they haven't paid you once, right. So when a financial institution will pull your credit, we're essentially assessing the risk, and we are trying to predict future repayment on a loan, because we're going to be lending out the assets of our company. So we want to make sure that this candidate will be essentially have good predictors of repaying other liabilities in the past.
I think it's only in the last few years that I heard about credit scores, and at first people talked about them once in a while, and then it got to be much bigger. I think a lot of people today are aware that they have a credit score.
And that's a really great point to bring up, Richard, because it's not only financial institutions that use credit reports now. Employers will use credit reports, because if you have some instability in your financial life, you might not be as productive of a worker. Insurance companies will use credit scores and credit reports, and actually premiums are based on that as well. Landlords use credit scores and credit reports. So a bunch of individuals in society really is grasping on to credit reports, because if you're financially healthy, that's just showing that you are stable and you're going to be stable in other parts of your life.
So even an employer could use them?
Most employers do actually pull credit reports, and if there's some instability, that could be a reason of not employing you.
So I would say just about everybody should be concerned about their credit report.
Absolutely. Absolutely.
Well, let's go into it a little bit then.
Sure. One of the things with credit, when someone's thinking about using credit, is they should really look at what I call opportunity costs. So with every decision, people have advantages and disadvantages to any decision that they have to make. So when you're thinking about using credit, what you're going to want to do is weigh out what those advantages are and what those disadvantages are. And it's really going to vary from individual to individual. So there's some benefits to having credit and to using credit, and first and foremost, it's the ability to have immediate access to something. So you might be in a store and you see something that you like. You have the convenience of your credit card or some other type of credit that you can use a check, let's say if it's attached to a line of credit. So maybe for some people an advantage would be that immediate satisfaction, but on the flip side, when looking at that opportunity cost, so the advantage might be getting to have that item right now, but the disadvantage is that you're actually going to be paying that back plus interest. So someone needs to weigh out those advantages and disadvantages. When someone's thinking about using credit, they should also really consider that it's not free money. Certainly interest can add up, especially on cards like store credit cards. That's another way. Some of those department store credit cards have interest rates as high as like 20 to 25%. So something that you might think, okay, well, I'm going to get 10% off if I open this credit card today, right?
Right.
But unless they pay that balance back in full, they're going to be paying back that 10% plus. So there's a whole spectrum of credit and when someone should use it. And there's really no right or wrong way on how to use credit. It's really up to someone's individual financial situation. So I think I would just like counsel someone, say to them, like, you know, it varies on each individual. Absolutely.
Okay, so we have a score. What is the score?
Scores range from 300 to 850 based on the credit bureau. So we have three major credit bureaus, Experian, Equifax, and TransUnion, and based on those three bureaus, they can range from 300 to 850. A credit score is essentially future repayment factors are given weighted scores. So a credit score is simply a numerical summary of future predictability of repayment.
And everybody's used to those. We get them in school. 100% is usually good, but in
Right.
this case, 800 would be more like an SAT score where you've got a higher score.
Right, absolutely. So when someone looks at their credit report, the first piece of information that is in their credit report is identifying information. And those are things that are not included in your credit report, in your credit score, excuse me. So identifying information would just simply be like your name, your address, future employers, any type of like phone numbers I've seen on there. So that would be identifying information at the top.
Any history of where you've lived or only?
Yep, there is
Okay.
some history. So it'll show a few different addresses of where individuals have lived. Generally, credit bureaus lag 30 days.
Okay.
So a lot of times there might be some type of error or discrepancy on that credit report in terms of identifying information on there.
So they try to make sure they've got the right person.
Right, right, absolutely.
Now what is actually, what are the factors that go into making up a score?
Good question. There's 5 major factors in your credit report. The first one is payment history. Then there's amounts owed, length of credit history, and types of credit used. And payment history is actually 35% of someone's credit score. So one late payment can have a severe negative impact on someone's credit score.
Wow, so one shouldn't forget their credit card bill.
Right, one should not forget their credit card bill. You try to be on time. So if it's past 30 days late, it will actually show up as a delinquency. And then
Now, if they waive that charge, is it still late?
It depends on how that lender actually reports.
Okay.
So let's say that maybe you're only a few days late and then you get a late fee on that. That generally is not reported to a credit report, but what is reported to the credit bureau is if past 30 days.
So then you've really gone to the next bill.
You got it. Yep, and it's hard for some individuals to actually catch up if they're late. So what I've seen on people's credit reports is a whole line of lates across because they were late once and living paycheck to paycheck, they don't have the financial means to actually catch up.
Right.
So it's a nasty revolving circle, so to say. So it's really hard to get from underneath it. So if you're struggling financially, I would tell someone to definitely, call the creditor and say, hey, listen, I can't afford to make this whole payment. Can we reduce the payment this month? So 35% is your repayment history.
4 to go.
Yep, there's 4 more to go. What I want to just discuss briefly on repayment history, though, is that takes into collection factors. So some things that individuals don't realize get reported to your credit report and in collection and count as this 35% of your credit score are things like medical bills. Medical bills are reported to your credit report. Your Niagara Mohawk or any type of heat and utility bills. If you were late on that or if that goes into collections, that's reported on your credit report. Things like judgments or liens. So a lot of times I might come across an individual who is past due on their child support. And that actually shows up, or any type of tax liens. So from a lender's point of view, if someone does not have the ability to pay their child support and they're coming to the financial institution for a loan, what's the probability that they're really going to be able to pay that loan if they can't pay their current obligations?
Now I know people can, before we get to the next 4 now, I'm going to interrupt us too.
No,
I know people can go on the internet and look at their credit reports.
Mm-hmm.
Would they see these other things on there as well?
Absolutely. Absolutely. So there's identifying information, there's the trade lines, any types of foreclosures or delinquencies, and then inquiries. So those are the 4 major things that actually show up on the credit report.
Okay, and so it's more complicated than just missing one payment. There are all these other factors that go into that 35%.
You got it. You got it. Absolutely.
Okay.
Yep. The next factor of the credit score that I discussed was amounts owed, and that equates to about 30% of your credit score. And what amounts owed is would be for a revolving line of credit. Let's say you had a credit card for $10,000 and you were maxed out on that for $10,000. Your amounts owed or available is 0 because you have zero available pay. But if you have that at 50% or below, then your amount owed or available pay would be 50%.
Okay.
So that's where amounts owed go into play.
And it seems like a lot of times credit card companies will set things high even when you don't ask them to.
Right. So that's a great point. What will happen is you'll get a letter, great news, you've paid your bills all the time. Right. We're going to increase your limit $4,000 on top of that 10 you already have. So now you have a $14,000 line of credit. And really it's a catch-22 because some financial institutions will look at that and they'll say, okay, well this person has the capacity, right? Meaning like you might have 5 $10,000 credit cards, so you have the capacity to run yourself up into $50,000 in credit card debt. But when a credit analyst or a loan officer looks at that, we'll actually see like what is your past reputation. So a credit report will actually show us what the highest you've ever been on that card for. So some people, there's that misconception like I have too much available, but if your reputation really isn't that of running yourself up to 50,000, maybe you've only had like 5,000 max on those cards, it wouldn't really be a big issue.
Okay.
There.
Good.
So that's amounts owed. The other factor into your credit report is your length of credit history, and that's actually 15% of your credit score. And the length means just simply that, like how long have you had credit? And a big misconception out there is maybe some individuals will have a bunch of credit cards and they want to close those credit cards. So what they'll do is they'll just start closing all their credit cards and maybe leave one open. That could actually hurt your credit score because it's going to ruin your average account age. So let's say you opened a credit card in 1986, let's say, and you closed your oldest credit card, and now your newest credit card or your newest liability on your credit report is 1996, you've just shortened your average account age by 10 years.
So jumping around with your credit cards may not be a good idea.
It may not, absolutely. And if you're going to take that proactive approach and start closing credit cards, which always is a good idea, especially if you're not using them, but make sure you close the newer ones first. Don't start closing the ones that you've had for 10 years, 10 or 15 years, because that's actually going to hurt your average account age, which is 15% of your credit report.
And my wheels are turning, so I would say that if you decide you don't like this credit card, you could still keep it and not use it much,
Absolutely.
Because it may either have made you angry because the way they did their billing,
Right.
but they may have added fees.
Right.
Just don't use it so much.
Just don't use it so much, or even, I have, I guess you would say, like trade lines out there that I haven't used for years and years and years that are just open lines, but I'm not going to close them because I don't want them to hurt that average account age. And when we're talking about length of credit history, it's really important because I'll meet a lot of younger individuals and they have no credit. So actually you have no reputation for paying people back, and it's really a struggle. So they'll come and they'll say, hey, I want to get this, $10,000 car, and it's hard for a financial institution to do that because we don't really know what your reputation is.
Okay.
So
I have to interrupt again and ask
Sure.
a question about the new person, the person
Sure.
who has, let's say they just got out of college. When you were here before, you talked about how when you first got out of college,
yes,
they were going to give you the reward of candy.
I did. I took it. I
So
took
you're-
my first credit card for a candy bar.
Now, obviously, you didn't have any credit history.
Mm-mm.
So has the industry changed? Because it seems like they want to give people cards.
And that's a really good point. Has the industry changed? That's hard for me to really answer, but I would think so. I think what's happening is now that you'll see that they'll give small limits. So for someone who doesn't have any credit, credit is an essential part to everyone's life, as we discussed earlier. I mean, it goes into any types of loans you're trying to get, your employer, your insurance, every factor, rentals of apartments. So you want credit, but to go back to your question is when someone's trying to establish credit, a lot of times credit card companies will give them a small line, like a $300 line. If they can pay that back over time, then they're good. But once you get that one line, you will begin to get inundated with credit offers. So again, it comes down to that control of you have the one credit card, are you going to use that responsibly and just use a little bit and pay it off? Or now that you got 5 other solicitations, are you going to go open those 5 cards and then just
Use them.
use them?
Right.
Right.
Good.
So
I hope we haven't lost track. We have a couple to go.
we have a couple to go. The next would be the next component of your credit score actually is new credit, and that actually equates for 10% of an individual's credit score. And new credit would be like how fast are you increasing your debts? Or how many new accounts do you have? And then how long has it been since you opened new accounts? So if you open a lot of new accounts, again, it's going to lower that average account age that you have because there's newer accounts on there. If you're opening a lot of new liabilities and maxing them out, that can be worrisome from a lender's point of view, and also the credit report or the credit bureau is
You
actually
may be covering up other debts somewhere.
You got it. So on a credit report, it will actually show us when the individual opened that card and what the current limit is and what the highest limit it's ever been. So if you were come and say, Rachel, I'm looking for a $5,000 loan, I have some things I'd like to do. And I say, okay, well, I pull your credit report and say, well, this individual has opened like 3 other credit cards in the past 6 months and they're maxed out. So from our standpoint, we need to figure out what is going on in this individual's life that they're opening all these new liabilities and actually maxing them out.
Right.
So that's new credit is
So
actually
that's a good thing to
right.
watch.
Right. So you don't want to open up too many cards or open up too many liabilities. I would say like to someone, and we're focusing now on credit cards, and we can get more into discussion.
And every
of
time you
different
walk
credit
into
cards.
a department store that you haven't been into,
Right.
or even the same one that you go all the time, they try to get you to give a card and
Right.
they take 10% off.
Right. And, sometimes it's worth it and other times it's not. But a lot of times those department store cards have this 22 to like 25% interest rate. So as I mentioned earlier, you might be saving 10%, but unless you can afford to pay that fully off, I wouldn't recommend doing that. And I've seen lists like 5 pages of store credit cards on individuals' credit reports.
5 pages.
I've seen them, yes.
Wow.
The last component of one's credit report is types of credit use. So that's 10% as well. And we'll look at, the credit bureau looks at, is it a healthy mix? Is this person just using credit cards, or do they have some other trade lines on there, such like it's a mortgage or a car payment? Again, this is your financial reputation. So we are seeing if there's a healthy mix, or the credit bureaus are seeing if there's a healthy mix on there.
Good.
So those are the 5 major components. It's really important to note, though, that even though these are weighted average, this is what Fair Isaac it gives as averages, but credit scores vary individually, so one component might be weighted a little differently in another individual's credit file.
Okay.
So a lot of times it will be frustrating to me because I will pull someone's credit and I'll say, why is their score so low? It looks like they pay everything. But again, we're just receivers of this information. These are just how, on average, they weight credit scores and how they actually calculate that credit score.
Now, just as an aside, you mentioned Fair Isaac. I know that's a company. It's a stock company, I think.
It's my understanding it's a credit rating agency. So it's Fair Isaac and Company. I'm not sure if they have stock as well, but
so that's their job.
Yep, and it's a secret formula. No one knows the exact formula of what goes into a credit score, but they relinquish this information, those statistics I shared with you, as averages. So this is how the average credit for the general population is weighted, but it can vary from profile to profile.
Do we know much else about these numbers?
That is about as far as I can tell, and in my experience.
Are there a lot of people that are at the top, or what categories? You have categories like a really good one or a really bad one, and what are kind of variations in between?
I have one statistic to share with you. Generally, each financial institution generally will have their own rating system, but the higher your credit score, the better predictability of paying back a loan because you've been given credit and you've actually paid that back. One thing I do want to mention, though, is that your credit score is not the only reason why someone would actually be approved for a loan, because there's other factors financial institutions take into place that predict stability. So you might have a average credit score, let's say, not great and not terrible, but you have 30 years on your job and you own a home, right? So that's showing predictability and stability of this individual's life. Is like, if you're a homeowner, you're generally more stable, and if you've been on your job, you have some stability there, opposed to someone that you're looking at who might have a really high credit score, but they've hopped around a job every 6 months, or they've moved around every 6 months. And additionally, when talking about predictability and actually granting loans, people have really high credit scores, but they may be maxed out. So 2 statistics I'd like to discuss quickly, and then I could give you the average credit statistic. Is generally you don't want your unsecured debt ratio, meaning your credit card debt, to be more than 20% of your income.
Okay, so that's debt that you don't have collateral for.
Right, like credit card debt. So most people do carry a little bit of credit card debt. So what you would do is just take however much you make per year. If you make $50,000 a year, times it times 0.20, whatever that number is anything above that would be considered excessive. So I've seen people with really high credit scores, maybe 795 or something, and
that's perfect.
It sounds perfect, but they're actually denied loan because their unsecured debt ratio is too high. So they may be coming and applying for a loan with a financial institution or with a credit union, but their unsecured debt is just too high. So generally, if something bad happens in someone's life, the first thing they don't pay is their credit cards, because they're going to want to keep their home and their house as well. Average credit statistics, the national average right now is a 692. It's pretty good.
Okay.
600 with us, 600 to 630-ish, that's average. Generally, anything below 600, you're higher risk. But again, if you have other factors involved in there, we might be able to approve loans. And it depends on the type of loan as well, because with an unsecured loan, the financial institution has no collateral. So that's considered more of a risky loan. So a lot of times people get frustrated with me or with the credit union because I will actually approve them for, let's say, maybe a $15,000 car loan. They're going to pay a little bit more for the risk they pose in terms of interest rate, but then I deny them for, let's say, a $2,000 credit card loan. And I say, well, that's only $2,000, but Thing is that the financial institution has no restitution
Right.
if they weren't to pay in that $2,000. And with a car, we would actually have some type of collateral to collect
Right,
on
that
that.
makes a lot of sense.
Yeah.
Well, then it seems like it would behoove people, regardless of the fact that it might not matter exactly how high your credit score is in a given case, you would want to improve it.
Right.
And
And
so, what can people do to,
improve their credit
Yeah.
score? Okay, well, for
other than reversing the clock, which
right.
is fine.
You know, and I meet a lot of people don't ask for bad credit. I think there's this misconception out there, you know, like, oh, they must have done something and got out of control. But generally what I've seen is that something's happened in someone's life and they weren't really prepared for it. They were not financially prepared. So let's say there was some type of like divorce or separation. That really hurts individuals' credit. Or they have health issues and they weren't prepared to go out on disability. Again, that hurts individuals' credit.
And
Or
these are things everybody has sympathy for.
absolutely, absolutely. So a lot of times, if you do come across or if you are in a hardship situation, the first thing I would tell someone to do is contact your creditors. So let's say you broke your leg and you can't work for 6 weeks or 6 to 8 weeks, 2 months, and you weren't prepared for that loss of income. I would certainly contact your creditors and let them know what's going on, because they might be able to work with you. They might be able to lower your payment for that amount of time and say, okay, well, maybe you can pay interest only on this car loan while you're out, or maybe we can give you a grace period on your credit card for a month or two. And this way it's not being reported to the credit bureau because you've already worked it out with them.
So now you're preventing that number from going down in the first place.
And that is the worst thing, and I think it's almost like a fear or a type of embarrassment, that something has happened I can't afford to pay, so that people will let the bills stack up and they'll just kind of push them away and hope they'll go away. But it's actually worse, because what happens is if this liability goes into collections, not only are you going to be paying back that original, let's say, $1,000 in credit card, but you're also going to be paying attorney fees. So that original collection for $1,000 might be like $1,700 or $18,000, or $1,700 to $1,800 because they tacked on attorney fees.
Oh, wow.
So with managing payment history, and it's not, it's not really that much. Pay your bills on time. I mean, that's the most important factor, and if you're having trouble, contact your collectors. If you miss a payment, get current and make sure you stay current, because it'll show lenders the past year of repayment history. So a lot of times I'll pull a credit report and I'll see like, okay, well, this person might have been late like during this time, and I'll say, what happened here, and it might be something like as simple as, I didn't get the bill, or it might be something like I was out of work for a month, and if they have it positive overall, then that's something that you can look past. So if you do miss that payment, make sure you get current.
Are there counselors who, I'm jumping in, I guess,
No,
too
that's
soon,
good.
so don't
Jump in.
stop, but are there counselors who can look at your credit online and make guesses as to what could be causing the number and give you advice that way?
There's, we do free credit report review. So any individual who wanted to review their credit could always contact the credit union, or most financial institutions will do that, and we'll review their credit and make recommendations. So I do a lot of workplace seminars, and what I actually will do is go out to individuals' workplace, and I'll sit down with the individuals during lunch and do general overview like I'm doing now, and then I task them with going and pulling their own credit, and individuals can do that for free. There was something called the FACT Act that was passed, where every American will get free access to their credit report, and they can do that on it's www.annualcreditreport.com. You'll be able to pull a free copy of your credit report, and then what I have those individuals do is actually I went back to their employer like 2 weeks later, and I sat down and kind of made recommendations of what they could and could not be doing better. So there's a bunch of different types of financial institutions or counselors out there who would be happy to help someone improve their financial situation, or even make recommendations on their credit.
Okay, good.
As well.
Now, I interrupted you before. I don't know
that's
if you can
okay.
get back there.
On the managing your payment history, it's important to for people to note that collection items won't be removed from your credit report for 7 years, so it'll just show as like a paid collection, which is good. I'd rather see a paid collection on there than an unpaid collection. And
So
then,
people are actually out there looking at them and making real-time decisions, and they can see improvements.
absolutely, yeah.
Good.
It's really like rewarding for me to see my members maybe who have been in situations where they haven't been able to get denied a loan. I've made some recommendations. They come back a year later and we're able to give them a loan. And
Great.
then, over time, a few years later, they're up and they have platinum credit, like things over 730. I'm like, hey, you remember when we just met, like 5 or 6 years ago and things weren't looking that great, and look at you now. You have all these terrific things and things are going good for you. So payment history is the most important thing. 35% of your credit score. One late payment, and I mentioned this earlier, has a severe negative impact on an individual's credit history.
And I guess the older that is, or the more aged it is, the
Right.
less important it is.
Right. What's weighted the most heavily is the past year.
Okay.
So for individuals who have had the situation where they actually had to claim bankruptcy, it's much more common than, the past generations. It's not as taboo. A lot of people claim bankruptcy for all different types of reasons, but the biggest thing after bankruptcy or after some type of financial hardship is how you pay going forward.
Okay.
So if I see that there was a bankruptcy on there, and then I see that a year later they're still, they got a little credit and they're not managing it good, then I don't want to say lesson not learned, but still, they haven't really, got things in order.
Right.
So their probability of getting some type of loan extended would be very low. But from then, I've seen people within like 2 years have a credit again after claiming bankruptcy.
Right.
From there. Trying to manage amounts owed, that was 30% of an individual's credit score. On revolving lines of credit, like credit cards, I would tell you to keep that low, like below 50%. And just try not to max out your credit cards. So sometimes you might have individuals who have a few credit cards, but they're all close to the limit. So in that case, I would just say to try to keep them lower, at least
So really,
below.
the thing that they would normally do just to get their finances in order is going to achieve the lower credit score.
Right. Yep. And then we'll talk about how lower credit scores give you a better interest rate too in a
Right.
little while. So, and then, I always tell people just pay off debt. Don't keep chasing the 0% financing. That happens so often. I have $10,000 in credit card debt, and but it's on a 0% financing for 6 months or a year, and I'm not going to touch it. And then after 6 months or a year is up, and they still have $10,000 but 0%, and then they open another card and they move it. So they're just kind of like shuffling it around. I call it the debt shuffle. But really, if you truly are making this commitment to get out of some type of debt, I would just say get one good interest rate and just make the commitment to pay it off. Don't keep chasing those 0% financing rules. Managing your credit history. If you've been managing credit for a short time, we talked about that, like younger individuals, it's actually more of a risk, not even younger or older. I've met individuals, in later years in their life who have always paid cash for everything, and they can't get a car loan because they've never had any type of credit.
And that seems crazy.
It is crazy, but it's hard to lend out, let's say, $20,000 in assets, but they've always paid cash for something. So we really have no basis to go off of. It's almost going in there blindly.
It's just the way it is.
So it's really important to establish credit, and the way a younger individual or even an older individual can establish credit would be maybe to go get a small credit card and then eventually get a secured loan like a car loan. The first thing that we're going to look at is how has this individual repaid a car loan if they haven't in the past. So someone might have trouble paying credit cards, but they've always paid their cars on time. They might be more likely to get that car loan versus unsecured loan.
I see.
Yeah, because they've had such good repayment on past car loans. So there's a lot of great...
Be selective that way.
Yep, and there's a lot of gray area when it comes to credit decisioning, but really with a credit report, it's strictly a numerical basis. We're going off of really non-biased things. It doesn't take into race or age or any of those other factor. So, years and years and years ago, you would walk in the bank, and if the manager liked Mr. Bob, then Mr. Bob got a loan, and that had some biases there. This is just strictly a numerical factor. It doesn't take into any other type of things that we discussed.
So lending is blind.
Yeah, can be. I mean, there's a lot of gray area when you're doing a loan, so it just comes on experience,
right.
Really. For establishing new accounts, shop around for a specific rate when you're trying to improve your credit score. I mean, don't just jump at the first rate you see. Make sure when you're going to establish new credit that you do shop around for the best rate. Reestablish credit if you've had some issues in the past. Again, reestablishing credit would be the same as someone who had no credit and wanted to establish it. Maybe get a small, what I would call a secured loan. And a secured loan is where you would put, let's say, $500 into your credit union or your bank, and then the credit union or bank would actually give you back that $500, and you would pay that loan back plus interest, just to show some payment history and positive payment history since any type of issue that you might have had in the past. And also, it's really important to select what types of accounts you're going to use. I mean, if you're thinking about going and getting a car, it's probably better to get a car loan because the interest rate on that is going to be much lower than, let's say, a personal loan. But we've seen situations where people want to get a personal loan because they don't want to have to pay the certain, we require comp and collision on all of our.
So you have the insurance.
So they have
but
the
you
insurance.
would have that, you don't need that if it's, if you own the car.
Right, yeah. So sometimes individuals will try to get around that and say, well, I'll just borrow $5,000 in cash and pay that back, but the interest rate generally is higher on secured debt because you're paying for the risk of it being unsecured than it is on a secured debt like an auto loan.
And you also have the liability of you may end up paying a lot more because you don't have the insurance.
Right, absolutely. That's a really good point.
Which is why you require the insurance.
Right, absolutely, because it's truly, it's really our asset until it's paid and the lien is released on that automobile. As well. So when selecting types of accounts, I mean, credit cards are certainly good, but make sure that you manage them wisely.
Very good.
Yeah.
One last thing before we end up, we talk about credit and we think in terms of things that, like a house, and everybody understands why you would borrow money to buy a house.
Right.
But I think sometimes the people must forget what credit is really for.
Right.
And lose control of their emotions and want to buy a new watch or a nice coat or a different car because of it's neater looking and...
Right. I think it really all comes down to needs and wants. I mean, we all need some type of shelter, right, to live in, but it doesn't necessarily have to be $1 million mansion. So I think that really individuals need to understand what a need and what a want is, and it comes right back down to that opportunity cost that we discussed earlier. So if you are going to buy that watch, let's say, then that advantage is you're getting this nice new watch, but the disadvantage is that maybe you are putting it on a credit card, or maybe you're undermining some type of other financial goal that you had set prior. So really taking control of your finances, I mean, you want to control your finances. You don't want your finances to control you. And credit is really a critical part of individuals' life, and I have an example here of the difference of how credit can make. So our financial institution, we do what's called risk-based lending. So you pay for the risk you pose with a lower credit score. So someone, let's say with a lower credit score, might pay 19% for a $15,000 loan for 4 years. Well, the monthly payment on that is $448, where someone with better credit would pay 6% on that same $15,000 for 4 years. Monthly payment on that is $352. So the person with the lower credit score is saving about $4,618 in interest with the 6% loan.
A year.
over the life of the loan.
And what was, how long was the loan?
4 years.
Okay, so $1,000 a year on that one.
Yep, yep.
Which over 40 years is $40,000.
Right, so it really pays to have good credit.
I came across some amazing statistics as I was trying to get ready to be able to ask you halfway intelligent questions. And the most shocking thing I came up with was the average person loses out on $200,000 of savings by the interest they pay on their credit cards over 40 years. And that is sad.
$200,000 in savings, where that could be sitting in a retirement fund.
There's
right?
4 years in a nursing home if you want to look at the darkest side of it, but still.
Right, and it's really analyzing, again, those needs and those wants. We all need food, but does it have to be a hamburger, or can it be, does it have to be an expensive steak?
Right.
Okay, we need to eat, but what are we going to eat? So as individuals are thinking about their individual situations and going to put something on credit, I always tell people, you're spending your future income.
That's a nice way to look at it.
You're spending your future income. So that quick swipe, I always try to think of things and how many hours it takes me to work for that.
Good point. Good point. Yep.
So it's really just trying to establish guidelines and self-control, essentially.
Which is exactly what sometimes companies are trying to erode.
Right, yeah, and it's behavior changes too. So, people get used to living a certain lifestyle, but if somebody is in a situation where, let's say, they are forced out on disability or something happens, they lose their job, your lifestyle is going to have to change. Just because you have access to this $30,000 in credit card doesn't mean that you should go and, run it up and live off of that. There's ways that there's certain services that could actually help you during those low times that I always encourage people to take advantage of.
And by losing good credit rating for things you don't really have to have, you jeopardize the credit for something that you might have used for an investment.
Right, absolutely. Like you said, $200,000 over
40 years.
40 years. That's a lot of money.
A lot of money. Well, I want to thank you a lot again, Rachel, for coming back.
Thank you for having me. It's been a pleasure.
Very important.
Absolutely.
And hopefully you'll come back again.
Absolutely. Thank you.
And I want to thank you for watching. I hope you enjoyed the show and that you'll watch again next time. Take care.
Welcome to Channel 17, the Town of Colonie Government Channel.